Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. It's really hard to decide where to put your £10,000 as an investment. You may think about making a business that requires you a lot of time to build and then later on manage, or an investment that promises you a big potential monthly earnings and then turns out unfortunately to be a scam. What if I told you that you'll be surprised what a £10,000 investment with dividend paying stocks can get you? In this video we'll go through different kinds of investments that will let you earn income through dividends and find out what the potential income you can get in your initial investment of £10,000. How big is £10,000 and its potential? Imagine your £10,000 investment as the beginning of a significant financial journey with the potential for substantial growth. It's not just a sum of money, it's an opportunity to build a stronger financial future. To make the most of it, you have to set clear goals for what you want to achieve with your investments. Think of your money as seeds that you can grow into a flourishing garden if nurtured wisely. Diversification, or spreading your investments across different areas, is like planting various crops to reduce the risk of a bad harvest. So whether you're just starting or looking to grow, understanding your £10,000 and making smart choices can pave the way for financial success. Dividend income investments. The S&P 500 index is like a basket of 500 strong companies known for being relatively stable and profitable over time. It's a relatively well-balanced group, which means when you invest in it, you're essentially owning a piece of various types of business that make up the entire stock market in the US. The S&P 500 has a history of providing good returns on investment, making it a popular choice among investors. When people talk about the market, they're often referring to how this group of companies, representing a broad spectrum of industries, is performing in the overall economy. So investing in the S&P 500 is like getting a slice of the entire economic pie. When you purchase an ETF fund or an index fund that tracks the S&P 500, you'll most likely receive a dividend yield of about 1 to 1.5%. The reason for this is that a big chunk of the companies in the S&P 500 are technology stocks, where the companies are focused on reinvesting their profits for the sake of companies' growth, instead of giving out dividends to the investors. So here is an example. Right now, VUSA, the Vanguard S&P 500 index, pays out a dividend of 1.18%. This means that you invest your $10,000 in VUSA or VUSA, and you'll only get an income of £118 a year. An example of an index that is the UK equivalent is the FTSE 100, which includes 100 well-known companies from the UK and is publicly traded on the London Stock Exchange. An example of a fund that tracks the FTSE 100 is the Vanguard FTSE 100 UCITS ETF, or VUKE. It currently offers a dividend of 3.83%. If you invest your £10,000 in VUKE, you can earn up to £383 a year. High dividend funds. Another option that would achieve a higher dividend yield is to purchase a fund that focuses on giving higher income and less capital appreciation. There are many high-quality options that hold stocks of stable companies that have a long history of paying out dividends. For instance, iShares UK Dividend UCITS ETF, or IUKD, listed on the London Stock Exchange, and this fund is a UK dividend ETF that tracks the performance of an index made up of the top 50 dividend-yielding stocks in the UK. With a dividend yield of 5.41%, your initial capital of £10,000 will earn about £541 of dividend income in a year. Many older investors prefer high dividend funds because they are more stable and tend to do well in market downturns, but not as well in market upswings. This stability, along with a consistent income, makes these funds popular among retirees. Sector funds. Another option for investors that want to achieve higher than average dividends is by selecting a sector or industry-specific fund. It's a kind of fund that holds different companies in one certain sector or industry, such as healthcare, energy, technology, real estate, etc. Some sectors provide higher dividends than most due to the different natures of each sector's business. For example, the technology sector actually offers little to none in dividends due to its nature that focuses on long-term growth. Technology companies are often very bad candidates for what I call natural dividend payers, and if they do make excess profits, it's better to use them on growing the business than paying out to us. Another example is the energy sector, which is priced relatively low and has a high dividend yield. Investors are often scared away and don't want to take the risk due to its nature of high volatility, economic fluctuations, and renewable replacements and regulations. For instance, Invesco Morningstar's US Energy Infrastructure (MLP) holds a collection of master limited partnerships that operate in the US energy sector that are known for higher dividends. If you invested your £10,000 in MLPP, you'd have an annual income of £838. Real estate investment trusts, or REITs, are also seen as ideal for dividend income because due to their business structure, they mostly distribute their profits to shareholders through dividends. Similarly, the iShares MSCI Target UK Real Estate ETF boasts a yield of 7.84%. If investors are willing to do some research and invest in sectors that are currently unpopular, they have the potential to earn higher returns. These returns can be in the form of both dividends and increased capital value as the sectors regain popularity. If you invest £10,000 in the UKRE ETF mentioned above, you could receive about £784 annually. While we're talking about ETFs, I just want to add that my recommendation for UK investors wanting to buy ETFs is InvestEngine, which is also where I got all the neat screenshots of the ETFs from. If you wanted to get an account with InvestEngine and buy ETFs like this for yourself, then it's a great time as you can currently get a welcome bonus of up to £50 when you invest at least £100 with InvestEngine. T's and C's apply, capital at risk. I also mentioned InvestEngine in my Best ISA for 2024 video, which you can see here. Individual stocks. Another option is to purchase an individual stock, although many finance experts recommend purchasing index funds or ETFs if you're a beginner investor and don't have a large portfolio. This way you can learn about market behaviour and receive stable returns and grow your portfolio without taking too much risk. Eventually you might decide to select individual stocks if you are willing to do the research and take the risk. If you choose to buy individual stocks, it's a good suggestion to search for stocks with a track record of increasing dividends. The Dividend Aristocrats list is a great starting point, since every company on the list has consistently raised its dividend for 25 years in a row. For instance, consider British American Tobacco plc, which has demonstrated 36 years of consistent dividend growth. With its proven track record of paying dividends, investing in such a company can provide investors with stability and a secure source of dividend income. With a dividend yield of 9.64%, your £10,000 investment will generate £964 annually. Another stock that's popular among dividend investors is Legal & General, ticker symbol LGEN, which isn't a dividend aristocrat as it doesn't have such a long history of dividend growth, but it has paid for 29 years. If you were invested in LGEN, Legal & General, then you could expect £788 a year, assuming the dividend is not cut. By the way, if you're wondering which broker I recommend for buying individual stocks, and I also mentioned it in my Best ISA for Metronome Investors 2024, it's Trading 212, which is also where I got these screenshots from. On top of that, I asked Trading 212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened up a new account recently, or planning to open an account, here it is. DivXP, or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. So that's how much dividend income you can get from your £10,000 investment, but here's the thing. These dividend income results of investing £10,000 into different types of investment come simply from the dividend yield of the investment. Dividend yield is a measure that indicates how much a company pays out in dividends relative to its stock price. In simpler terms, it's a way to calculate the annual income you could potentially earn from owning a certain stock as a percentage of its current market price. Here's a simple formula for dividend yield. So if a stock is trading at $50 per share and pays out an annual dividend of $2 per share, we can work out the dividend yield. And this means that for every $100 invested in that stock, you would receive $4 in annual dividends. Investors often use dividend yield as one of the factors to consider when evaluating the income potential of a stock. Keep in mind that a higher dividend yield may not always be better, as it could be a result of a falling stock price or an unsustainable dividend. It's important to consider other factors in the overall financial health of the company before making investment decisions. So all the examples given in this video show dividend yield, but there is much more to how a stock performs. Let's take a look back at the high-yielding fund in the energy sector, the Invesco Morningstar US Energy Infrastructure MLP. If you remember, it had a dividend yield of 8.38%, which is very high. Now let's look how the price has performed over the last 5 years. If you bought the stock exactly 5 years ago, then you would have received income, but be down 4.62% on the stock price. If we look at another of the high yielders, British American Tobacco, we can see a similar story, down 15.92% in the last 5 years. So although they do have high dividend yields, the stock price fluctuates too, and in these examples it's fallen. Here's another example of a high yielding stock with a dividend of 8.93%, but in this case its share price has also risen 9.97% over the course of a year. So why am I telling you this? Am I saying you should go out and buy M&G shares and ignore British American Tobacco? No, absolutely not. This isn't a recommendation to buy or do anything. What I'm trying to say is that dividend yield is only part of the overall picture. In summary, while dividend yield is crucial for income-oriented investors, it is just one piece of the puzzle. Total return, incorporating both capital appreciation and income, gives a fuller picture. Considering factors like reinvesting dividends, taxes, risk, and market conditions offers a nuanced perspective beyond focusing solely on dividend income. Investors aiming for a well-rounded view of their portfolio's performance should appreciate the significance of total return as a comprehensive measure, accounting for the dynamic nature of financial markets and the interaction between capital gains and income generation. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!